Good afternoon. My name is Ilko Kruizinga. I hope you're all fine and safe. I represent the EIP-SCC Marketplace project together with my colleague George, who is also visible on this slide, the gentleman speaking in the microphone on the bottom right. And together we are organizing a series of webinars around important topics related to scaling up of smart city projects, especially from the financial side. This is actually our second webinar. And for this webinar, I'll be your moderator and taking you through a series of presentations and a question and answer session. The presenters for today are actually two gentlemen, Michael Pachlatko, who's actually the Vice President for Finance of Dual Assets Europe. And Dual Assets Europe is also part of our investor network. And Michael and his team have been quite active and are still active in the Horizon 2020 project called the Launch project. And that project has given the world a risk assessment protocol to help de-risk projects, particularly smart city projects related to sustainable energy assets. And Michael will be leading us through what that risk assessment protocol is all about. And then he will be followed by a team member of his, Quentin Neerings, who would present around, let's say, the practical experiences from using that risk assessment protocol from a financial actor perspective, because he's affiliated with the BNP Paribas Fortis. Now, before we go into the actual session, I just want to go through the agenda with you all. First of all, I want to share some housekeeping rules so that we all keep this neat and tidy and within time. Then I will speak a little bit, just a few seconds, around what the EIP-SCC Marketplace actually is and what types of interventions and services we provide to smart city projects across Europe. And then George will take over and just briefly address the topic of risk assessment, why that is an important topic for financiers of smart city projects. It slightly relates to the previous topic we had in our previous webinar that was around due diligence. Then we have the two gentlemen doing the presentation. So Michael, first of all, will be taking us through the risk assessment protocol itself. And then Quentin will give us an insight of how that could be practically applied within the context of a bank. And then, if all goes well, we'll have some time for questions and answers and some conclusions. Now, first of all, the housekeeping rules. As you might find, and probably you have been in webinars before during these Corona days, that you're all muted by default, actually to minimize background noise and to help us focus on the content. But we will have a question and answer session at the end of the webinar. And we will then unmute yourself, but you can ask questions either by raising your hand during the Q&A session or anytime during the session itself using the chat box in the control panel that you see visible to yourself. It's actually on my right, probably it's on your right as well. And if there are too many questions, given the time, then we will get back via email post the webinar to answer any questions that you might have. And again, you may have seen it from the splash screen right at the beginning. This webinar will be recorded and will be posted to the Marketplace website for later replay. Now, what is the EIP-SCC? It stands actually for the European Innovation Partnership on Smart Cities and Communities. And actually, it is a platform that brings together cities, industries, small and medium-sized enterprises, investors, innovators, researchers, and many other smart city actors, with a view to leveraging all of the R&D that's going on around smart cities and make that into sort of real life action in cities, and to scale up from the innovative experiments that the European Commission funds through its funding programs. Now, what we do is we have organized our work into three areas, and so the words that go along with that is the three words: explore, shape, deal. So we are helping smart city actors to explore existing good solutions. So we sit on a database of smart city solutions that contains both quantitative performance data on what might be achieved with smart city technologies, but also qualitative information around the lessons learned and good practice stories themselves. And overmore, we provide through that database you with contacts that you might engage with to learn more about those solutions. And then the second pillar, called the shape pillar, is the set of interventions that we have to help shape smart city projects. And we do that through a series of so-called working groups or action clusters and initiatives on various sort of hot topics in smart city land. And I invite you to go to our website, and the details of those will be shared at the last slide of this webinar, to explore what those working groups are all about. And maybe even you can join them if you want. And we do have a series of regular workshops and webinars like this one, and we provide you with tools to increase the bankability of your smart city project. So that's the shape arm of our work. And then the third arm of our work is around creating deals. So we do organize, and we have organized actually a face-to-face matchmaking event with investors, because we have set up and are setting up an investor network. We are continuing that using virtual technology as well, and we are planning to have a next matchmaking event with investors in June. More details later. We have an open call for concept notes, proposals ready to be matched with the requirements of our investor network. So if you have a very good project concept, we're happy to take those concepts, review them, and match them, if possible, with the requirements of our investor network. And we will provide you with guidance on how to create those bankable investment proposals. We have a web platform that's actually now being migrated to a Europa server to be relaunched in June, but the existing web platform is available to you as we speak. Now, with that short introduction, I want to hand over to my colleague George, who will be sort of addressing the risk assessment and risk assessment protocols from a wider perspective before we go into the launch risk assessment protocol. So, George.
Hello, everyone. Thank you, Elko, for this introduction. So, as Elko mentioned, my name is Jorge Almeida. I'm part of the EIP-SCC Consortium, and I will talk a little bit about why risk assessment is key for the bankability of projects. I will be quite short because I want to focus on the protocol itself instead of focus on this thematic. As you know, we have presented this before. We have divided or we have created a project maturity level framework that aims to put the projects that we get from the calls for projects to develop the matchmaking, to put them under a certain project maturity level. So that project maturity level goes from 1, where is just a potential project that has been identified, to 6, where it's ready to launch the tender and all the requirements have been fulfilled. And what happens in the middle is that we are going to develop, or the project developer in the city is going to develop the project following steps by steps. And under this step by step, one key element that it's not written here, but it always has to be in the back of the mind of the people doing that work, is the risks. For each of the stages, there are several risks that must be identified, analyzed, and every time that it's possible, be mitigated. For instance, if we talk about the technical parts of the document of the project, we must focus on the technical risks and trying to understand them and see how we can, if they are complicated risks, see how we can overcome them. So what is risk analysis? According to Investopedia, I like this 3 sentences that they have there. Risk analysis is just the process of assessing the likelihood of an adverse event occurring. So that could be different types of events that could occur during the project lifetime, and for those events, we need to understand them and see what kind of risks are associated. The risk can be investigated and analyzed in two ways, quantitative and qualitative. So different approaches that must be taken. And I like this sentence that they had there, and I never thought about like this, but it's a fact. Risk analysis is more an art than a science. And the reason for this is one of the reasons for this is, for instance, the lack of standards that cover all the process. And this happens because the risks are so different as the projects are. So given that we have very different projects, we will have very different risks. And we have to always keep in mind that car loans exist for more than 100 years. Mortgage, we have more data about it because they have been around for more time. But when it comes to sustainable finance, smart cities, we have a lack of data. We have a lack of financial performance data. That means that we are not aware of all the risks that are around. And that is a problem, because when we don't know the risks that might come, so investors or financiers, they will have some kind of doubts whether they should finance or not the project. And how can we overcome this? Basically, we can start using the standardization and using risk assessment protocols, such as the ones that Lunch will present. This is a sentence from their website that I really like, because it's just talking about standardization. If I standardize the way that I perform the risk assessment, that will encourage the market to grow and will be able to perform the securitization of projects, so make sustainable energy assets as tradable securities. And just the last slide, because we are all aware that factories, they need standardization, but sometimes we forget that banks or investors, they work like factories, so they also need standardization. And yeah, I will give the floor now to Michael to present the risk assessment protocol. Michael, the floor is yours.
Thank you very much, George. And hello, and a warm welcome also from my side. I'm very pleased to see such a significant interest in a topic that usually would be considered rather dull and dry. In the next 10-15 minutes, I would like to introduce to you the Launch Risk Assessment Protocol, a tool that we have developed over the past year and that we believe will help accelerate project underwriting and due diligence work for all players involved in this specific sector. And I do need to hope that I will not be too dry on this subject. First, just a few words on the Launch Horizon 2020 project. Dual Assets acts as coordinator of this 2.5-year project, backed by a European Commission grant, and has partnered with the Dutch research organization TNO, Luxembourg-based fund manager Enersafe Capital, the Irish ESCO New Energy Group, and the Belgian bank BNP Paribas Fortis. Altogether, basically, we are representing an industry that fails to show its full potential. In fact, should we even stand a chance to finally be reaching the hundreds of billions of additional capital to be invested in energy efficiency upgrades in Europe, we need a vast improvement in both speed and scale. And this is exactly what the Launch Consortium is trying to achieve, accelerating deal closure and enabling pipeline growth, also in view of creating sustainable energy projects as securitizable assets that can be traded on capital markets. Two of the key elements in this work are the Launch Standardized Client Agreement and the Launch Risk Assessment Protocol. Both are designed to support ESCOs with standardized processes and elements, but at the same time, we involve the investment community all along the way in order to ensure that we are addressing the needs of the financial world with them. I will focus my presentation on the risk assessment protocol, but as we shall see, many risk types directly relate to the standardized agreement. And this really makes these sort of twinned tools to be applied together. So how can we better assess risk, and how does a better risk assessment help in this context? I will try to illustrate this with a little timeline of some of the main steps involved in energy efficiency project investments. Having worked for a number of years in this exact spot between the ESCOs and the investors, we at Dual Assets have seen time and time again how risks and the lack of transparency or information about them create friction points in this process. These can be anything from dubious assumptions about energy price growth to unclear roles and responsibilities between the ESCO and the client, to the lack of clear measurement and verification procedures. We are not pointing fingers at anybody here, but it goes without saying that this often represents a high potential for frustration for all parties involved. Time is wasted, money is lost, and deals do not get financed. Now, this is our unfortunate experience on the project-by-project basis, but of course it will be equally relevant for other financial parties involved in an eventual securitization process, such as a securitization vehicle or an eventual buyer of a security, of a bond, for example. What is important is to eliminate these potential friction points as quickly and early in the process as possible. We of course understand that all investors have their own methodologies, benchmarks, and risk appetites, and will continue to do so. What we are developing here is a tool that helps communicate the relevant information at the relevant time in a way that also contractors know that they will cover all necessary aspects with whatever financial counterparty they deal with. There are a number of advantages that we can expect from such a tool: better risk management with a complete and standardized set of information, enhanced transparency that helps to avoid nasty surprises along the way, an increased efficiency, so information will be presented ready-made to the financial players and it will be available early in the process, thus reducing overhead costs. And finally, there is also a competitive advantage. We clearly see how this could lead for both ESCOs and investors to an advantage in their own sectors, particularly also in view of incorporating ESG-related information. I will be talking a little bit about this later on. All right, so let us now have a closer look at what exactly the risk assessment protocol covers. There are a number of specific risk types we need to consider when looking at an energy efficiency project, and we can categorize them broadly into three distinct groups. The exogenous risks refer to conditions and circumstances that are external to the actual project opportunity. Here we see, for example, regulatory, market, or currency risk, which are all driven by outside factors. A second group consists of endogenous risks. These risk types are inherently linked to the design of the project or certain contractual or structural elements that indeed are under the responsibilities of one or several project stakeholders. Of course, not all of these risks will be in the same way important or even applicable in any given project. Still, each of them has to be assessed for a number of key questions. What is the potential risk impact? Can we quantify it and model its financial impact? Who bears the eventual consequences? Is it the contractor, the end client, or the investor? How can it be mitigated? Is there insurance, for example, or can we hedge the risk? At the core, however, we see a very specific risk type that is widely considered the most important risk for investors, and this is credit risk. So I'd like to take a moment to focus on some key aspects regarding credit risk in project investments. Credit risk is essentially counterparty risk, and we therefore need to assess it for all counterparties involved. At the minimum, this will be the contracting party and the ultimate beneficiary of the installed equipment and services. Credit risk refers to the likelihood of receiving timely and sufficient cash flows, and therefore needs to take potential default rates into account. Usually, the end client's credit risk is given more importance, as it is always easier to replace a contractor or operator of the equipment than its beneficiary. In many cases, the installed equipment couldn't really be recuperated, either for technical reasons or simply because it wouldn't be economical. On the other hand, there are various other risk types we've covered on the previous slide that ultimately would have an impact on credit risk too. If, for example, performance risk or occupancy risk or energy price risk is shouldered by the contractor, any significant negative impact on these areas would indirectly affect its financial situation and thus increase the contractor's credit risk. It is therefore essential to assess the financial standing of the counterparties early in the process, and each investor will have their own methodology and benchmark for doing so. In certain countries or for certain companies of a certain size, external credit ratings will be available too, which would of course facilitate the assessment. Now, even though we obviously can't take away this work from the investors, we can still take preliminary steps and try to broadly understand the financial situation of the clients we are dealing with. We can consider this a sort of pre-qualification process where we screen and sort out unsuitable counterparties. And here on the right-hand side of the screen, I have just included a number of the ratios and tests that we have included in this credit risk assessment part of the protocol. The source of information is always the standard financial statements, the balance sheet or the income statement. Now, how will the risk assessment protocol actually be used in practice? It will be the responsibility of the contractor to fill in the protocol for each project separately and to supply the necessary documentation for all the claims that are made within the protocol. The aim is to collect this data as early in the process as possible in order to have the whole risk-related dossier readily available for all eventual financial counterparties on the way. Now, as already mentioned before with the credit risk, the idea is to be descriptive, not to be prescriptive in this process. In other words, the launch risk assessment protocol will not provide a rating, but rather allow investors to have all the relevant information displayed in a complete, transparent, and standardized way, in order then for them to assess whether specific risk levels are acceptable or not. While we are clearly aiming at producing something meaningful and valuable for the investors here, we have to ensure, however, that the use of the protocol is still practical for the contractors and their clients as well. So this is very much the kind of two-pronged approach that we have to be taking here in the development of the protocol. And while it may first seem as a bit of an overkill for a contractor to fill this protocol in for each new project separately, we have actually seen that the clear majority of risk types will eventually contain the same information across projects. That could be on technology or, for example, in the market and the regulatory environment that they are active in. So it is mostly the information related to the end client that will have to be changed from project to project. In other words, once the protocol has been filled in once, every subsequent submission should go much quicker. As you can see in this overview here as well, there are also a number of risks that directly relate to the end client agreement, the launch standardized agreement, which of course further facilitates the work for an ESCO using both tools together. I show you here quickly a screenshot of the current protocol for one individual risk type, the regulatory risk. Essentially, the risk assessment protocol is structured as a questionnaire with the same key areas covered for most risk types. It's the relevance, so how can the risk be quantified and is it relevant in this context? The responsibility, so which party would actually bear the risk? Mitigation measures, if any, as mentioned, insurance or hedges, and then this segment on the documentation, listing all the necessary required documentation in support of the claims that are made. Eventually, we are going in the direction of also producing a summary of key risk factors that will allow for a quick benchmarking by its readers, so that's the investors, and also a full list of the included documentation. We try to avoid wherever possible the need for lengthy explanations, but rather keep the questions to straightforward yes or no questions or asking for quantitative responses. We are constantly improving on the format of the protocol, making sure it's easy to use for the contractors, but at the same time also easy to understand for the investors. As mentioned earlier, we are currently 1 year into the launch project, and the work on the various tools is an ongoing process as we go in cycles of development, feedback and testing. I would like to point out just 2 of the main next steps in the development of this protocol. One is related to ESG criteria, so non-financial, environmental, social, and governance criteria. Here we see a strong need from the financial community to have this included as an additional risk type into the protocol. We will be asking from the contractor in the same way as for all other risk types to fill in the relevant information regarding potential ESG factors. We will make sure to align this fully with the EU taxonomy on the environmental parts. And then, of course, wherever there is a potential overlap with other risk types, for example, governance, factors that are overlapping with the management risk section, we will identify these and try to remove the overlaps as much as possible. On the other hand, we have an ongoing discussion with insurance companies on some of their standardized policies that they offer to address and mitigate various risk types, be it technical or performance risk. And so that is also an ongoing work that we are doing with insurance companies over the next months. Finally, just a couple of words on how you can get involved here. I don't want to limit it to ESCOs and investors, of course, but maybe just to address these 2 main categories. As an ESCO, you can, of course, join us in the launch education pilot. You can stay informed on the latest developments of the launch tools. These are all published on our website and are there to be downloaded, and we would be more than happy to have you test these as well in real life projects. So please do get in touch in case you're interested, and we really want to make this as applied and as interactive as possible. Finally, we also offer in launch support in other areas, sales process, value propositions, or access to growth capital. These are all areas that you can read more about on our project website. As an investor, you can join the Launch Investor Board. We have already more than 15 different investors on our board. We are very happy to have such a good group of experts around the table that provide feedback on the development of the tools, and also making sure that they are really most valuable, designed in the most valuable way for them. Also in this regard, we have just recently started with an ESG working group within this investor board, just working on the specific area of ESG factors and ESG risks. This is all for now from my side. Feel free to get in touch with any questions you might have, and in case you're interested to be receiving the risk assessment protocol. I would now like to give the word to Quentin Nerings from BNP Paribas Fortis to hear more about the bank's perspective on risk assessment. Thank you very much.
Thank you, Michael. So I'm Quentin Nerings from BNP Paribas Fortis. I am in a team which is active in structuration of small projects, so projects which are under the 50 million threshold for Belgium. In this role, we participated in the launch project in order to be able to structure and to facilitate the financing of projects, of energy performance projects. So it was the occasion to share a bit our thoughts and our feedback on this. First of all, there is one thing we have to differentiate in the banking world, because as you speak about banks, there are often in the energy world 2 types of banks. You have the investment banks, which will do mostly project finance, like a financing approach. And you have the classical corporate lending banks. And Fortis is mainly for Belgium a lending bank, a corporate lending bank. What are the difference between this approach? These are quite huge difference. The project finance approach will be based on future cash flows. It means that they will have quite a huge and heavy due diligence process in order to be certain, to be sure, or as sure as possible, that these future cash flows will effectively be generated. To do this, most of the bank have specific teams, specialized teams in the part of the investment banks. And due to these specificities, this kind of financing is mostly not for every bank. For example, in Belgium, in my team, we are a bit of an exception in that. But for most of the bank, in the international bank, the project finance approach will be only used for projects above the 50 millions, which is for energy performance project just not so relevant because most of these projects are smaller than 50 million euro. Then you have the other approach, the corporate lending approach, which it's the classical role of bank, which will provide financing to a company. Here, the bank will not really, I am a bit of exaggerating, but the bank will not really look at the project. What will the bank look at? It's the historical record. It's the accounting data of the company. And if these are good, the bank will be able to lend it. The advantage of this approach it's quite easy and with not a lot of other costs financing approach. But this, as you see, these two approaches are very different because in one approach you have an easy approach, but we will not look at the future cash flow, or not a lot look at the future cash flow. And the second approach, which will look at the future cash flows, it's far more heavy, but has also its advantage. And for energy performance project, these two different approach, it's quite a challenge, and I will explain why in the second slide. That's what for the introduction. Now I have to just give a bit explanation about the scope of what we are doing for launch. And here the scope is really what happens after that a project has been given to an ESCO. So all the procurement process, all the public competition which is done is not part of what we are speaking here. Here we are speaking about an ESCO we has won a project, was won an EPC contract for a company, for a public authority, and this ESCO wants to finance this contract. We want to finance this project. So that's really, here we are speaking about the ESCO's perspective, not on the final client's perspective, which has of all the public authorities or the private company. It's quite important to add. So for a banker, and that's why I say EPC contracts are quite difficult. Why? It's because this kind of contracts are in fact hybrid contracts. You have part of this contract which are in fact project performance contracts, because you have performance guarantees and you have a need to maintain these installations. These aspects are directly linked to the performance of the ESCO, to the performance of the project. And as I said, most of the time in banks, these kinds of risks are assessed via a heavy due diligence in specialized team. The other part is the risk, and as Michael said too, the credit risk, which are what the final client has to pay. And as I say, this is mostly assessed by classical lending banks, which are not really familiar with the performance risk to assess a performance risk of a project risk. So you see, this is really the difficulty for a classic bank about EPC financing. It's because you are really mixing two types of risks, which are generally analyzed by different teams inside the banks. What does it mean? It means that you have, as I said, two approaches, which are not often not often mixing themselves, and so you have in front of you a banker, or you are in front of a project finance bank. Bon, if you can reach quite huge amounts. In this case, this project finance bank will not really be keen on taking the counterparty risk because they don't understand that. It's not their work to analyze a counterparty. On the other way, if you are an ESCO and you are going to your bank and asking for financing, it will be a possibility that your bank will not be comfortable in taking a performance risk, a technical performance risk. And that's why you have to help the bank to assess the risks. And that's why a standardized contract, a standardized risk approach, a standardized risk model could help you to structure how are the bank looking at the risks. And it's really important to do that. And also, as ESCO, for this kind of project, you have to use a bit of pedagogy for your banker because it just cannot do that. It's not what it's used to, this kind of project. It's too complex for him. So if an ESCO is contacting its classical bank, okay, its bank know them. So that's not really a problem. You have to give a business plan, you have to give him perspective, but all in all, it will be okay. But what the banker of the ESCO doesn't know, it's the credit risk of the ESCO's client. And the problem is that the bank are private companies, so they don't have a lot of time to assess all the risks. And so if you want to help the banker, you will have to provide him information about the risk of your counterparty. And so he will have to use the same language as your banker. Second reason to do that is because in a bank, the person you will have in front of you is mainly not the person who will take the decision. So give to the person, to the relationship manager, the good argumentation he will have to use in front of the person we are taking the effective decision in the bank. Really important. Third aspect, the techniques. Yes, in a classic bank, in a lending bank, your banker will normally, in most of the time, if you have the chance to have a bank which has some technical people, then it's perfect, but it's mostly not the case. In a bank, he will probably not know anything about techniques. And don't over give your banker too much information about the techniques. What do need the banker about techniques? It's just to have comfort on the fact that the risk of the techniques are mitigated. So the banker doesn't want information about the techniques. The banker wants to have information about how the risks of each techniques is mitigated. And will prove him that it's under control. And so having a good risk mitigation plan is really something you could use and which could be helpful. With all these tools, you will be able to explain the risk at the banker, and it will give the banker far more comfort because for a bank, it's not really a problem to have risks. The problem is that when a banker does not understand the risks. If you have risks and you can explain them and explain why these risks are mitigated, a bank could do that. They could take these risks. But if the banker see a risk which has not been identified and does not have any mitigation procedures or aspects, that could be a real problem. So some of conclusion of these small hints of a bank. First of all, you have to select your bank financing partners. All banks have, as it has been said previously, all investors even have different ways to look at risk, different policies, different procedures. If you are speaking about a banker on a project, and if you don't see a lot of support from him, of comfort from him, change your banks, because it will be a pain in order to move forward in the financing of this project. Secondly, as I said, you have to give your banking partners perspectives. Energy performance projects are mostly small projects of 1 million, 2 million euro. For a corporate bank, it's quite small amount. So if you want that your banker take the pain to understand your project and move forward with you as a partner, you really have to give him perspective on future projects to give him a vision. And then, as I said, give yourself the risk and the mitigation to your banker. And that's why I think that standardized assessment protocol could really help doing that, to structure all the aspects and all the procedures. Voila, that's a bit the hints and the feedback I wanted to give about the risk in a bank, which is, as you said, sometimes some kind of an art, even if it's a bit strange to call a banker as an artist, but okay. But what is true, it's different for each investor, different for all bank, and so the more the information you are giving the bank about the risk and the way you analyze the risk, the less chance you give to the investor or the banker the place to interpret it himself, all the risks. Voila, and I give the mic back to Eclo.
Thank you, Quentin. Thank you, Michael, for these inputs. Very useful and insightful, and also, let's say, frank as well, because indeed a frank approach is what we need here as well. So if I can ask my colleagues in the back office to make sure that people are able to raise their hands and contribute with any questions that they might have, because they're now all muted. In the meantime, I can see in the question pane there have been some questions around availability of the presentation afterwards. Yes, we will indeed share the presentation in a follow-up message to all participants of this webinar. So that's one thing. To get us started, I can see a question. I guess it's addressed to you, Quentin. It's a question from Michael Edelstam. He's asking whether aggregation, and that's almost an infamous word as well, aggregation of a number of projects make it more interesting to a bank to achieve a certain volume, to achieve a certain portfolio, to make it interesting over and above the, as you said, the small, the lowest threshold of 1 to 2 million euros per project. So maybe Quentin and maybe Michael can follow up on that question, because I think it's actually quite relevant.
Yes, it's absolutely relevant. It depends on the type of bank you are speaking with. If you're speaking with the project finance department of the banks, aggregation will certainly be relevant, but do not forget that you will have to reach a 50 million euro threshold of investment in order to interest a project finance department in an international bank. Local banks have a lower threshold. Secondly, the challenge is to build the portfolio. Because, as I said, a project finance department is not really comfortable with the counterparty risk. Indeed, with the risk diversification, you can lower this risk, but it has to be built, and that's really the challenge. On the other hand, a local bank or a lending bank, corporate lending bank, could be interested in the project of 1 or 2 million euro. Certainly, especially if the ESCO is a client of is known by this bank. But then you have to do a work there is a bit of work in order to create a sort of guidelines with your banking partner in order to standardize the way these projects are financed, and so you have to really create a partnership with your bank. It's really needed. If you are not able to do that, it will be really hard to finance it via the banking channel. And so it's really, I think the 1 million, 2 million project could be interesting for corporate lending banks, less for project finance bank. In both cases, you will have to explain and to provide more information than usual to your bank, because the challenges are different. I hope that my explanation was good.
Thank you, Quentin. So is Michael from Joule Assets having a view on aggregation from your point of view?
Or, yeah, I mean, I can add to what Quentin has been referring to from the bank's perspective, and maybe just refer to some of the most active types of investors that we are having in our network, and these are usually some dedicated funds investing in sustainable energy projects. It is quite diverse. We see funds with minimum requirements as well of 1 million or 2, others with lower thresholds of maybe only 100,000 euros. But the key, of course, is really to show a potential for aggregation or a potential for pipeline as well. So an ESCO that can bring a number of projects of at least the same technology, the same structure, maybe not exactly the same end client, but possibly it could be also with a hotel chain that a number of actual buildings and a number of actual hotels are lined up in a pipeline, and eventually will lead to some economies of scale, because this is indeed, of course, the key aspect here. An investor would normally not just touch a single 100,000 euro project as a standalone opportunity, because the overhead costs would simply just get too high, and it would simply not pay off eventually, or the cost of capital would just simply get too high for the contractor and the client. So project aggregation definitely is an important and also valuable aspect in this regard, and investors in this network that we are looking at are indeed doing this all the time and looking for such ways to aggregate. And what we, of course, then try is to provide the tools here with the risk assessment or the standardized agreement to even further allow for commingling of such assets that also then respect the same terms and conditions with their clients, treat risk in the same way, and so on and so forth.
Thank you. There is actually a question also around clearly around the COVID-19 crisis that's now ongoing. Is that clearly that is affecting let's say also the risk profiles and risk appetites and credit ratings of organizations? So is there any sort of recent, very up-to-date view on that? Is that going to be included somehow in launch, or does BNP Paribas have a view on this in relation to this risk assessment protocol?
It depends really on the sector, on the type of project. If you are in energy production project, so in a photovoltaic project or something like that, it will not have a lot of consequences because this kind of project are small, really low sensibility to the risk linked to the COVID. If you are in energy performance project where your cash flow are depending on a counterparty, as I said, it's really be linked, the importance of the assessment of the credit risk of the counterparty will have a lot of importance. And so it could depend. Local authorities, it will depend on the risk appetite of your financing partner, first of all, and then on the risk profile of the counterparty. Even with huge debts for a lot of banks, not all, but public authorities will be considered as having a lower risk, not for all the countries, but for Netherlands, for France, Germany, Belgium, it will be so. And then about if you are a private company, if you're the beneficiary of the energy saving measure is a private company, it really be depending on the credit assessment that the bank will do, the financing partner will do, and preferably with the help of the ESCO. And that's why, again, the risk assessment could really be interesting. It's to provide to the ESCO the first tools, as Michael said, to help him to assess himself the final client, the counterparty. Because if the ESCO is going to a financing partner with a really bad counterparty, he will himself lose some of its credibility. And that's something you prefer to avoid.
Okay, thank you. So in the interest of creating some interactivity, I can see some people who actually have further questions. Can I invite Daniel Magnet to voice that question?
Yeah, excuse me. Good afternoon. I'm just
maybe you can sort of state your name and your affiliation before asking the question. Yeah.
Daniel Magnet, EVO, Efficiency Evaluation Organization. I just wanted to ask the question about your standardization on M&V techniques. Usually we do consider M&V as a good mitigation procedure when you're dealing with energy performance contract or any type of guaranteed performance commitment. How do you address in your standardization, how do you address M&V?
I guess that was a question for me. The way it is addressed is that we basically require a contractor to fully disclose the M&V plan, so the algorithms and procedures that are put in place for evaluating the project's performance over the lifetime. We recommend to be following also international standards. There is, of course, IP-MVP. There is an ISO standard as well. We are not, again, prescribing any particular approach in this regard, but it is all about ensuring that it is fully disclosed in a transparent way. So an investor gets the necessary information right away, and there are no surprises also in this regard, because of course measurement and verification is a very delicate area where surprises would even occur after a deal has actually been financed and the project is in the operating stage.
Thank you. You know, my question was more about the way the other party is evaluating this M&V plan. As you just said, that the M&V plan could be something quite difficult to understand or delicate. So it requires on the other party side needs a certain knowledge about these ISO or IP-MVP protocol. And how do you, what are your suggestions on how the other party, that means the client or the bank evaluator, would be able to fully understand the M&V plan?
I will speak on the bank's point of view. It depends on the level of maturity of knowledge of your banking partners. If you have in front of you somebody which knows a bit of techniques, he will be able to understand an MVP plan. But I think that in most of the times you will not have this kind of guy in front of you. So a banker will not go really deep in the techniques or in the MVP plan. What the banker will have to and it's what I mean when I say do not go too long on the techniques themselves. Go more on the mitigation. What the banker will want to see if it's not really the whole details on the MV plan, measurement and verification plan, but it's more answers on what happens if the final client, the public authorities, does not agree on the calculation of the ESCO. That's the kind of question your banker will ask. He will not ask about how do you calculate that. He will ask more what has happened if the final client does not agree on that. And then in the contract, you will have to provide an answer to that. And that's why also a standardized contract could help in order to have this kind of feedback loops. And for example, to have the present, to define the fact that you have to have a moderator, a facilitator, which a third party, a neutral third party, which will be able, in case of disagreement between the final client and the ESCO, to provide a neutral answers, which could not be patent doped. That's this kind of things in a classical bank will want to have, but they will not. I speak again only for as a banker. They will not go deep in the technical details because they will not have the technical competencies in order to that. Oh yes, maybe, but with external due diligence. And as Michael said, if you add all the external due diligence, then you crash the financials of the project.
Okay. All right. So thanks. So thank you. In the interest of time, let's move on to one final question. I do invite everybody to post their questions in the chat so that we do have a record that we can come back to. So maybe I can see a question from Bernard Gindreau. Are you okay to ask the question?
Yes, good afternoon, and thank you for this very interesting webinar. Yes, it's not really a question, but following the meeting we had in last February in Brussels for the General Assembly, or annual meeting, sorry, we agreed and proposed also to organize by the end of the year, probably in November during the General Assembly meeting, a workshop dedicated to our standardization in support of these, let's say, financial scheme or issues for cities and communities. And when I say we have already been in touch with Jules Assets Europe, but also Jessica and Federica so far. And the idea is to have this organization between the Sentinelec and ETSI and the Sector Forum for Smart and Sustainable Cities and Communities. The action cluster on integrated planning, policy and regulation. I'm an initiative leader in collecting all the, let's say, expression of needs for standardization development. So I would really suggest to stay in close touch, all of us, and trying to start elaborating what could be the content, the scope of such an event. I think it's very useful. We have seen also in the energy sector, the Energy Efficiency Financial Institution Group was finally very, very successful, but it took years before we moved to something agreed, a standardized scheme or guidance that also allows speaking the same language between decision makers and investors. So standards will definitely play a role. I fully agree with that. And I propose to stay in touch in that sense and see how we could move ahead with this organization.
Thank you, Bernard. So thank you for that message from an important body as that you represent. I just want to give the final question to Loïc, who has been waving for some time now. Could you briefly state your question, because we do have a few minutes left and we have some closing messages as well. So Loïc, if you are ready, then keep it brief for us. I'll give you the floor.
Hi, sorry, can you hear me?
Yes, we can. Yeah.
Great. Hi, everyone. Thanks again for a really interesting webinar and some really interesting perspectives. I was just curious to know, Quentin, what your and other investors' views were on sort of the customer end user using a bank guarantee to work around any credit issues.
Thank you, Loïc, for that question.
It's perfectly valid guarantees. In a bank point of view, the value of the guarantee will depend on the credibility, the bank credibility of the bank, of the institution who are giving the guarantees. But yes, it's a way to securitize the credit, so for the financing. Yes, it could be. Absolutely.
Thank you, Quentin.
Great,
so,
thank you.
Thank you. So in interest of time, we have a lot more questions. We don't have time for that. I just propose to proceed with the final, remarks on this webinar. But do rest assured that we will come back to you and trying to answer the questions that you might have, both the marketplace team as well as the people from launch. So if you are having a smart city project concept but lack the finance, so come to us, come to our website, submit your project concept note. The URL is available there. We will then assess it using what George presented, the project maturity level model, and try to match it with the requirements of the investor network, as I stated earlier. I think it's a main reason of existence as a marketplace to scale up good smart city project concepts, to find finance for it. So we are there to help. Also, I want to draw your attention to, and as I said it before, this is actually a series of webinars. Our next webinar will be on delivery models and funding and procurement related topics for smart cities. It will be hosted by our partner ICLAI. It's scheduled to take place on the 18th of June. Just so pencil that into your diary. And we also want to, have a sort of big bang thing before the summer. We are organizing a masterclass, meaning that we want to bring together those people who do have a, let's call it a semi-mature project concept, and work together with a number of experts in a group, virtually obviously in these days, to increase the chances of finding finance for that project. So we are sort of planning that, working hard in the background to organize it. Date not yet established, but it will be somewhere mid-June. Just so keep in touch with us, sign up for our newsletter, but also keep in touch with what the launch people have for you available. There is a community. They have a website, as Michael already suggested, launch2020.eu, easy to remember. And they have their social media channels as well. And they as well have a webinar on sales processes and marketing messages, how they could help accelerate the closure of deals. Again, the date for that is not yet established, but it will be somewhere in this month. Then my final slide is around staying in touch. This is the URL I promised you, eu-smartcities.eu. That's where you can find the call for project concept notes, the availability, the opportunity to sign up to the newsletter, and the various social media handles are there on this slide as well. So with that, I want to thank you for your attention on behalf of the EIP-SCC Marketplace team, on behalf of myself, Ilko Kruijsga, and my colleague George, on behalf of the presenters of this webinar, Michael of Dual Assets and Quentin of BNP Paribas Fortis. I think it has been very worthwhile, lots of interaction, lots of unanswered questions. But again, we want to come back to that later on in the next few days for you. This has been recorded, so you can replay if you missed something. The slides will be shared, so everything will be available for you. So I want to thank you for your attention and stay safe. Bye-bye.